Hi, and welcome back. It's a pleasure to be with you all. Today we'll cover effective tax rate and what it really is. I am your host, Brian Shakarami, and let's get started. So our topic for today is taxes, but we want to talk about the effective tax rate. What is the effective tax rate? Well, in short, your tax bracket does not have to equal your tax rates. So I guess a better way of putting it is that the effective tax rate is basically the rate that you are effectively taxed at. And it has to do a lot with your yield before and after tax, yield or internal rate of return. So it measures how much you're really taxed at, not just your tax rate or tax bracket, what you're really taxed at. And this is usually less than the ordinary income tax rate, which is your marginal tax rate. It is generally less because of two reasons. One is your cost recovery, recapture, which reduces the ordinary income tax. Two, it's because of lower capital gains tax at the time of sale. Because even though the cost recovery results in greater capital gains, the gains are taxed at a lower rate and are not taxed until the property is sold. So how is this effective tax rate calculated? It's basically a ratio of your before tax yield and after tax yield. And it is basically your before tax yield minus your after tax yield divided by before tax yield. Again, this is a percentage. Our after tax yield or internal rate of return is derived from the after tax cash flows, which already takes under consideration factors such as ordinary income tax, the capital gains tax, and the cost recovery recapture tax. The impact of these three factors is that it dampens and reduces the amount of taxes that we have to pay as an investor. An example would be a great way to explain this. So what we'll cover here in our example is that we will reduce the cash flows of the alternative investment to their NPV or their net present values for comparison purposes. Also, at the same time, we will obtain the yield or the internal rate of return for before and after tax for our example. However, the yield or the internal rate of return is what we really need in order to be able to determine our effective tax rate. So let's drive our points home with an example. Our example starts with a purchase our president is making. Donald Trump has acquired an office building for $22 million. He plans to sell it in 5 years, and the first year's NOI is $950,000. And this NOI escalates at a rate of 1% per year. His acquisition costs were $75,000, and he expects to sell the building in 5 years at a disposition cap rate of 4%, based on the building's 6th year NOI. The building improvement allocation is 80%, and his disposition cost of sale is 2.5%. Mr. Trump's corporate tax rates are 37% for ordinary income tax, 20% on capital gains, and 25% on cost recovery recapture. What is Mr. Trump's effective tax rate? In this case, what we've done is we've put everything that's been given to us in this chart, the property assumptions and also the investor's assumptions, meaning he's going to be holding it for 5 years, and the following are his tax rates: 37%, 25%, and 20%. So it's a hodgepodge of a few tax rates. We will then work to do the cash flow, which starts with basically the money that he puts down for purchasing the building plus the acquisition cost. This is for before tax, and also his before tax cash flow or net operating incomes from year 1 to year 5. and followed by the sales proceeds at year 5. We do the same thing for after-tax cash flow. And from these two, we obtain our internal rate of return or yield. If you're thinking, where did all these numbers come from? Here and here for before and after tax, and also the sales price. This is where they come from. So when we run the 5-year numbers for Mr. Trump's building, we come up with the cash flow before tax, which is depicted here, which goes to these here. And for the after-tax cash flows goes here. Notice that the acquisition cost remains the same for before and after tax. And how we get the sales proceeds, it basically comes from the calculations of adjusted bases, adjusted for capital gains and ordinary income. So we have the sales proceeds before tax, which goes here. And when you adjust it for the ordinary income and recapture and capital gains, the sales proceeds after tax would be $23,095,266, which goes to the after tax. From here, then, it would be very easy to determine our yield or our internal rate of return. Notice that our effective tax rate comes from the internal rate of return or yield before tax and after tax. If you recall, our effective tax rate was before tax IRR minus the after tax IRR divided by the before tax IRR. So now that we have the before tax IRR and after tax IRR, we run these numbers through this equation, and lo and behold, we come up with our effective tax rate being 23.39%. So if we look at the numbers and look at the assumptions for Mr. Trump, the ordinary income tax rate of 37%, capital gain from cost recovery 25%, capital gains from appreciation being 20%. But when we have done our numbers, the effective tax rate, what Mr. Trump is effectively being taxed at, is 23.39%. And I want to add that most of this gets taxed at 37% without everything that we went through to get to this effective tax rate. Therefore, real estate is a great investment tool for reducing your taxes. So what we just covered was effective tax rate. And if you have any questions regarding what we just discussed, please drop me an email to the following link and I will get back to you. Thank you.